Your market news now. Asian shares tracked Wall Street futures higher as Amazon provided some welcome earnings relief, while bonds were able to sustain a rally amid signs of U.S. inflation that is easing. All eyes are on U.S. data later this afternoon and the closely watched U.S. personal consumption expenditures for September. That's what we're looking out for, and it's the Fed's preferred gauge for inflation. Meanwhile, China's blue chip stocks gained 1%. Hong Kong's Hang Seng Index surging 1% as well after data showed profits at China's industrial firms extended gains for a second month, adding to signs of stabilization in the world's second largest economy. To talk to us about the latest on the markets and help us look back at the week that was, we are joined by Patrick Matidi, who's the head of equities at Aluwani Capital. Patrick, thank you so much for your time. I mean, given this backdrop of mixed corporate earnings coming out of the US, that stronger than anticipated US GDP figure, I'm wondering whether our local markets are in any way reflecting some of the Springbok fever ahead of the kickoff tomorrow.
Good afternoon, Nastasia, and thanks for having me. Despite the positive news that we are seeing on the U.S. front especially, unfortunately, not a lot of that is actually rubbing off onto our markets. Perhaps the only area where we are seeing some strength is on the currency. The rand is now comfortably below the 20 level against the dollar. The 19 level against the dollar. So that is great, given that it was at some point about 1920 or so earlier in the week. But despite that, our market is down year to date. But also, I think we are heading for the third month of straight losses if we continue on this journey to the end of October this year. So it has been tough. And I think if you look at it from today, we are literally flat, despite those news that we saw overnight.
Looking back at the week, were there any key themes or company news that caught your attention?
Yeah, I think on the company news side, I think two extremes. So on the one hand, we continue to see a lot of strain from the PGMs, just given what's happening there from that commodity price, the platinum groups. But then on the other hand, you're seeing the gold stocks actually doing quite well. A lot of that being driven clearly by the conflict in the Middle East. But specifically on the company side, we had Clicks reporting yesterday, very good numbers in terms of revenue, in terms of profitability, and they continue to see growth, in terms of rolling out stores, despite an environment, that has been characterized by, consumer strain and the lower disposable income as a result of high interest rates. So for some reason, they're doing very well. I guess it's the nature of the business where people tend to want to spend, to look good and feel good about themselves, despite the difficult times that we're experiencing. And then on the other end, we're seeing the likes of famous brands. So these guys, they sell pretty much, the fast foods. So the likes of, Wimpy and then pizzas, and they're looking at growth from outside of our shores, into the rest of the continent, where, I guess, the growth prospects domestically have since been exhausted. So they're looking at other jurisdictions like the DRC, Egypt, and I think Ivory Coast, where they think hopefully there will be better prospects. So a bit of a contrasting and a sort of outlook, where on the one hand, one company that being Clicks seeing a lot of growth still, and then on the other, the likes of famous brands, looking for growth opportunities outside of the country.
We had U.S. tech earnings this week. How important were they earnings from, if you had to look at it overall from an earnings perspective?
Look, I think they were very important. So I think to date, for the quarter end in September, about 78% of U.S. companies that have reported actually beat expectations. So that is great. So that gives you some comfort that that economy is actually still robust. And I think it was evidenced by the the GDP numbers that came out, which about 4.9%, which is very, very solid. I think we need to see other sectors to see if indeed the earnings and growth that we're seeing out of the tech is actually replicated in other areas. So I think today we should see the likes of Chevron in the oil space in our reporting, but we need to see the broader U.S. Corporate earnings results coming through, just to give further comfort, because on the tech side, a lot of it is just being driven by AI, which is a great phenomenon, but we need to see if that translates into other sectors within that economy.
As the head of equities at Aluwani Capital, how important is it for you for these tech companies to be able to monetize their AI capabilities versus just being able to lay out the groundwork for mass adoption?
I think that's key, because if you look at the rally and the gains that we have seen, especially for the Nasdaq, which is the key indicator of the tech index in the US, that ran very, very strongly up until a few weeks ago, leading into the results season, where we saw a lot of profit taking, largely on those concerns that you're mentioning, where the market is saying, well, you've done well in terms of laying the foundation, but you want to see the extent to which you can monetize. And I think with the result that we saw, especially out of the likes of Microsoft, do provide some glimpse of hope that indeed, this is not just a fad that is likely to pass away, but that there are actual benefits that companies can actually sort of bank as a result of this phenomenon that is called AI. So we need to see a lot of that into our sectors. Yeah.
Yesterday, we had the ECB meeting. To what extent has that ECB meeting and the comments coming out of that set the tone for next week's Fed meeting, given that both countries are dealing with different situations, or rather both regions are dealing with different situations on the ground?
Yeah, I think the Fed, are slightly ahead in terms of their hiking cycle. I think the ECB perhaps have been a bit late, but also, those two jurisdictions have got different problems, right? So the common one is inflation, but if you look at the growth prospects, the ECB or the Eurozone has actually lagged quite significantly, with a risk of, a sort of a stagflation being sort of a top of mind. Unlike the US, where you have, you still have inflation, which is coming down, but you also have got good growth still that underpins that economy. So I guess for the Fed, the biggest challenge now is, the growth that they're seeing as evidenced by the GDP numbers and the earnings numbers. Does that come with inflation, or is the path towards lower inflation still on track? And I think we'll have to wait and see what they say when they meet, sort of later this month or early next month.
As we wrap up, just quickly, your thoughts on the market reaction on the back of those US GDP figures?
I think the market reacted very well. I think, again, the question is now, sort of cautiously looking at the Fed to say, will the Fed, overlook these numbers and just focus on inflation, which is coming down, and therefore not hike? Or will the Fed look at these numbers and say, shucks, these numbers will come with inflation, so we therefore need to be preemptive and therefore hike in anticipation of inflation coming through? And I think, that's going to be occupying the markets over the next few days leading up to the Fed's meeting.
Patrick, thank you so much for your time. That is Patrick Matidi, who is the head of equities at Aluwani Capital. When we come back, we'll have a look at SME on point. Stay tuned.